Good afternoon, good morning, everyone. We are about to launch into our webinar today. We have several hundred people attending this webinar today, and we're going to do our best to start on time and finish at the 30-minute mark. But it's important just to outline that these events, we have found that the 30-minute timeline provides everybody who's so busy right now with enough time to jump onto these webinars and to get some important information and go back and implement it in their, at their job. So give us a couple more minutes and we will launch into this again. We're going to try and start on time today. Thank you all for being here. And we'll give it a minute or so before we start our discussion. All right. So it is 1 o'clock Eastern time. Thank you all for being in this webinar today and for joining us today. We're going to be discussing Fannie Mae and Freddie Mac's new condo and co-op lending guidelines that were released on the 5th of July and go into effect on September 18th. But most lenders are starting to implement these new lending guidelines already today. A little bit of the cleanup prior to this launch of this presentation. I'm Orest Tomaselli. I'll go into a little bit of detail of who I am at Condotek in a minute. What's important to know about this event is that we really encourage you to ask as many questions as you like. We're going to try and leave a little bit of time to answer questions at the end. If we do not get to your questions, and of course you can type your questions into the chat or the question feature, we will certainly try to answer you directly and provide that answer, should it be something germane to the whole entire group, within our post-webinar email to you, which will include a recording of this presentation. So thank you again for being here. Let's jump into it. I'm Orest Tomaselli. I'm the president of Project Review at Condotek. I have been in this industry for a very long time. At this point, I think it's over 22 or 23 years, primarily working in the condominium and cooperative lending compliance arena. Condotek is, has been an incredible force in this industry. And a couple of years ago, my prior firm, National Condo Advisors, was acquired by Condotek. And Condotek provides, a plethora of services, essentially, to condominium lenders and new construction and established condominium and cooperative developments. And among those services are our two key products, which are the Condotek product, which we provide condominium documents to lenders who originate condominium and cooperative loans. We also offer the co-op pack for lenders who originate co-op loans, and our Condo project and co-op project warrant products, where we not only collect all the documentation that's necessary for review with either agency or portfolio lending guidelines, but we review it and warrant that documentation to a specific agency lender compliance and or portfolio lender compliance. Couple of coming soons from Condotek. We are very actively working with portfolio lenders to work essentially to provide a portfolio lender review for those specific lenders. So the lenders that are on this call that have portfolio, condominium, and cooperative products, please reach out to us. should you want a specific review completed for your product line that we can underwrite to. We do that throughout the industry now, and it's been becoming an incredibly successful product that we offer to lenders. So let's delve into this, because these guidelines that were released on July 5th and go into effect and are effective September 18th are quite important for condominium and cooperative lending. On July 5th, Fannie Mae and Freddie Mac released their new lending guidelines. Essentially what these guidelines did is essentially take the 2022 temporary guidelines for Fannie Mae and made them permanent. And most of the guidelines made it into the permanency of their current guidelines, or the guidelines that are going to go into effect on September 18th. What there is within these guidelines, and if you read through them like we do, because we study them, right, there's a renewed focus on aging infrastructure. And originally when these guidelines came out, they were touted as guideline changes that were in response to the tragic collapse of the condominium development in Surfside, Florida. And as a result of that tragic collapse, the industry has changed dramatically, especially essentially how it looks at and how it views aging infrastructure. And I think the most important thing I could say within this entire event today is that I'm on board and Condotek is on board. We look at these new lending guidelines as something that's necessary for the industry, something that's important for the industry to, make sure that owners of these condominium and cooperative units across the United States have a healthy and safe environment to live in, and are aware of the financial health of their condominium and cooperative developments. And for decades, we've seen, condominium and cooperative developments that, were not healthy, that we had, terrible results from, some sort of massive issue, perhaps not as terrible or tragic as the condominium collapse at Surfside, but it doesn't have to be that tragic in order for it to be devastating for condominium and cooperative unit owners. It could be a financial issue within the development that causes massive foreclosures and homeowners and owners of these condo and co-op units to go without access to housing. And the goal here by the agencies and a lot of the secondary market investors now, which I'll explain, is to ensure that this aging infrastructure is thought about, that there's money sitting in reserve accounts in order to pay for the necessary repairs and maintenance to these large mechanical or structural components, and that, that essentially everybody is aware of how much capital is necessary in order to do that. And that's been lost on a lot of condominium developments. So just to move forward with this, one of the other major guidelines that came out of, or major, impacts, I think, from these guidelines is that, during the 2022 condominium guideline release, Fannie Mae outlined that reserve studies were not acceptable for review. And now that has changed dramatically. Freddie Mac has always allowed for the review and acceptance of reserve studies, and Fannie Mae, within these new condominium lending guidelines that have become permanent, have removed that restriction. So now reserve studies, which I'm a big fan of for lots of different reasons, are accepted by both Fannie Mae and Freddie Mac for review. And frankly, there is now a mandatory review of reserve studies and engineering reports if they exist on a property, and if they are less than 36 months old. So the focus again is this aging infrastructure and looking into the components and seeing what the condition of those components is, and seeing when the last time those components were replaced, and seeing what the cost is as it relates to how much a condominium or cooperative development has in their reserve account and or whether or not they have access to that capital through means of a capital loan or a line of credit. The other big news that came out of these guidelines is that Fannie Mae has introduced this, mandatory requirement for all condominium loans to be submitted through their condominium project manager system, their CPM system. And that's really important because I think, what the agencies are doing is essentially to try and get, historical data on these condominium and cooperative developments, even if it's, the first time that it's been submitted through CPM, just to essentially make sure that lending in 3 years or lending in 5 years or lending in 10 years can be tracked back to a CPM submission and to see what happened over that period of time. At Condotek, we have data sets and information on a little bit over 65,000 condominium and cooperative developments across the country. And we have that data so that we can look at it internally and see what the historical issues have been within those condominium and cooperative properties. And I think the agencies are doing the same through this request for a condominium loans to be submitted directly through the CPM process. So that, of course, launches on September 18th as well. So lenders that are on this call, I'm sure you're aware already, but every single condominium loan has to be submitted through CPM. It's important to note there, by the way, that the CPM submission, even if it appears that the condominium is approved through the CPM process or on Fannie Mae's list, lenders still have to determine whether or not there's any, critical repairs that have to be done to the property, and whether or not there's any deferred maintenance on that property right now. So it's not as if you're absolved of all responsibility of review. There are still, incredibly important things to find out about that property, even though it does appear as an approved property on that list. And that stands true for Freddie Mac's LP system as well. So I sent out a couple days ago the top 5 changes to the condominium lending guidelines, and of course, as I've outlined, the structural and mechanical critical repairs and deferred maintenance is certainly the biggest change to these guidelines. So these new lending guidelines essentially reiterate and now make permanent the requirement to have critical repairs completed prior to lending. So we're going to start with that statement because that's a really important designation here. If you have a condominium development that has, my favorite example, an HVAC system or a roof that is, in the process of being repaired, that is a health and safety issue. If there's some sort of major issue or critical issue with that development. And I'm going to switch screens in a little while, and I'm going to show you, something on Fannie Mae's FAQ, which I love, that will lead you to the right answers should you be questioning whether or not something is, a critical repair or not a critical repair. But the focus here really is the health and safety of the unit owners, looking at large mechanical systems within the development, looking at structural components and seeing that and making sure that those specific systems and components are in good working order. Again, if repairs have to be made to those systems and or components, they have to be completed prior to lending. You can't be in process on them. And what is being identified right now is, deferred maintenance. Through that mandatory requirement for review of reserve studies or engineering reports that have been performed on the property within the last 3 years, the agencies are really looking into, how a condominium management firm and or board is caring for the components and their condition in the property. So that's one of the biggest kind of, reaffirmations to these guidelines that became permanent, and probably one of the biggest things that we're seeing in the industry that is causing, a second look at condominium cooperative developments. And look, I want to say very clearly, there are a lot of condominium and cooperative properties throughout this country that have done a very good job. Their property management firms have done a good job. Their boards have done a good job in ensuring that these large mechanical components and structure is in good working order. But that is not true for every single development. And we find, on average, about 10% of the developments that we review that have massive issues with the, deferred maintenance and or critical repair, structural or mechanical components. The next biggest kind of change or, focus of these new guidelines is on special assessments. And there's always been a review of special assessments required by the agencies. And not only do you have to outline what the assessment term is, what the amount of the assessment is, you have to outline what the repayment terms are going to be by unit owners. But what's been added has been this, $10,000 per unit number that, from Fannie Mae that outlines that if you have units that or special assessments that have more than $10,000 in a special assessment per unit over a 12-month period of time, that is in most instances, a reason for that development to be rejected. So there's a lot of math that goes on behind the scenes when we do a condominium or cooperative project review. And you should know that there are a lot of developments that have massive assessments and massive unit owner costs in regard to these assessments for repair and maintenance of components in the development. One of the best examples right now is Florida, where statutorily reserve studies are now required to be performed on every single condominium development in the state, again, as a result of the tragic condominium collapse in Surfside. And what's happening in Florida is that they're finding out via these reserve studies being performed that repairs and maintenance have not been performed, and that reserve accounts, even if a development had a 10% line item for a reserve in the past, that money was quickly spent, and reserve accounts are have very little capital in them. And that's, again, a major issue when you're thinking about the health and financial health of a condominium development, and also the future ability of those unit owners to make repairs, right? Without an established reserve account with enough capital in it, it's tough to do repair without a special assessment. And those special assessments are really being reviewed with a critical eye right now. One of the things that's really important to understand is that both agencies, and I think very clearly Fannie Mae has outlined that a capital loan repayment essentially of a special assessment is accepted, and capital loans are accepted in many instances to essentially create a vehicle for making these repairs to the development. What we have to say about capital loans is I really think that in the future, in the next year, you're going to see a lot of developments seeking capital loans in order to align with these lending guidelines, but also that it's a great future way to pay for mechanical and structural repairs, and to have that capital available now in order to do so if you have a development that doesn't have an established reserve account with a lot of money in it. The only caveat to that special assessment and capital loan requirement, or allowance, I should say, is that if you have a critical repair that has to be performed, it doesn't matter if you have a capital loan, even though it's accepted. The critical repair has to be complete before mortgage financing is available. The third major point to outline here is property violations and litigation. There's a mandatory review of these things, and a real heightened focus on what the nature of the property violation is and what the litigation is, and whether or not a violation or litigation against the property has to do with deferred maintenance, right? If there's a structural issue in the development that has been highlighted by a state or a municipal agency that has done a review of the structure of a condominium or cooperative development, those property violations are, of course, public data. And in every instance, when a loan is performed through in a title search, you're going to have access to those. You can have access to those property violations in most states just through an online search. But there is a critical review now of property violations and litigation and how it is impacted by the, and if those violations and or litigation is because of some sort of, repair issue on the development. And again, a real focus on health and safety. And, this is public data, so many developments that have issues are immediately rejected if they haven't, made the repairs that resulted in the violation and or the litigation. So important to know for everybody. The fourth, out of my top five is special assessments. There is again oops, sorry, I went the wrong way. The fourth here is reserve studies, and capital loans. So reserve studies, again, are accepted by both Fannie Mae and Freddie Mac right now. But we have to understand with reserves and reserve studies, you have to have substantial reserves in accounts. We see a lot of reserve studies from across the country. And by the way, reserve studies and reserve study firms are not created equally. We've seen some that, are woefully short of what, the industry standard is for reserve study reporting. But we see a lot of buildings without any money sitting in their reserve account. In every single reserve study, there's a mechanical and structural component condition review. And that's really important to understand because that is something that is necessary for a reserve study to be compliant. But more importantly, it is a source of truth about a condominium development condition. Now, for reserve studies performed by a professional engineer, even better because those engineers have licenses and they're, it's an important designation between, let's say, a contractor performing a reserve study as opposed to a professional engineer. We put a lot more credit in the hands of engineers because they do have that licensure and in their opinion about mechanical and structural property condition. What's important to know is that a 10% line item in an operating budget for reserve in many instances right now is not enough. Sometimes it's overkill. I mean, we see properties with $2, $3, $5, $10 million sitting in a reserve account, and they're incredibly well funded. The 10% reserve line item is way too much for that specific development. That's not a lot out there. If I were to guess, I would say the majority or, 70 or 80% of the reserve studies we see have line item prescriptions of more than 10% reserves, excluding new construction developments, of course, because components last for that are created right now last for decades in some instances. And the reserve studies that we're seeing in the industry, dependent upon who produces it, show a lot of information that you need to review a condominium or cooperative development for compliance. And that includes if they have a capital loan and the utilization of the capital loan and the focus on this future, planning for the repair and maintenance of components. So we're a big advocate of reviewing reserve studies and or engineering reports, but really reserve studies, because engineering reports really focus on one issue, whether it's the structure or whether it's the facade, but reserve studies really take all the mechanical components and structural components in their totality into review. So there's a big focus on reviewing these reserve studies if they're available and they're less than 36 months old, along with engineering reports. And again, if these reports exist, there's a mandatory review in order that has to be performed in order to determine condominium compliance. The last and fifth, out of my top five is insurance compliance and the changes in the lending guidelines. So there's a real increased focus on deductibles. And the insurance industry right now, dependent upon the state, is in somewhat of a disarray. I'm sure everybody on this presentation has seen the news articles in the last couple of weeks about Florida and the inability for many condominium and cooperative developments across the country, but specifically in Florida, many condominium developments that just can't get insurance, can't get HOA insurance. And that is as a result of these large insurance companies pulling out of the state entirely, not insuring any condominium or cooperative development in the state. And that's primarily because of previous losses that they've incurred through, large catastrophes, whether that's been hurricanes or flooding, and the amounts of cash that they had to pay out. So we're seeing this very unique period of time where there not only is a pullout by lots of insurance companies, essentially not wanting to insure properties in a specific state, but surging insurance costs for condominium associations. We've seen, on average, 100 or 200% increases in insurance costs for condominium developments in certain states. In one state, we did reviews on condominium properties. We saw increased costs that were 800 or 900% higher than the previous year's policy. So what does that force owners and board members to do? In some instances, just to get the premiums to be affordable, somewhat affordable, or not, just to cut the cost, they're increasing their deductibles. They may not get the type of quality insurance that's required by the agencies. And essentially what they're doing is shooting themselves in the foot. So there is a real major focus on insurance policies. And in the past, I'm going back a decade or so, you really didn't have to spend a lot of time reviewing a policy itself and what it stated. You could just look at a deck page. But a lot of the details of these, cost cutting that the insurers and condominium associations and boards have done is really in the meat of the policies. And in most instances, you have to review the entire insurance policy to get to the bottom and to figure out, kind of where that compliance or non-compliance is. So there's a lot of problems with insurance. And what you should expect right now is essentially properties that don't comply with the agency guidelines for their deductibles, or if they don't have enough capital in their accounts to pay for the deductibles. Good example there is if you have an insurance deductible of $250,000, which we saw on one property, and the condominium association has limited funds in their reserve accounts or operating accounts, stands to reason that if there is a tragedy on that property or some sort of cataclysmic event, that they wouldn't be able to make to rebuild the property or to make the unit owners whole because of that loss. And of course, that's a financial issue for the development. Of course, it speaks directly to the financial health of the property, or what the future financial health could be if there was some sort of cataclysmic event. So there is a major focus on insurance compliance right now, and it's something that we're doing on every single review that we perform within our condominium project warrant. There are difficulties in getting a lot of the information from insurers. It is causing major delays in the industry of closing condominium loans and getting condominium loans approved and or project reviews done, because not only do you have to get, acceptance of this process by the property managers and boards who are completing the condominium questionnaires, But in many instances, you have to go to the insurer and get a copy of the policy. And sometimes they don't want to release it. And sometimes they don't want to release the financial details of it. And it is unfortunately causing delays. At Condotek, we have a couple of tricks that we use in order to get those policies, all above board, by the way. But we really try really hard when we get an order from a client for condominium documents or cooperative documents or for review, to use any means we possibly can in order to get a copy of that policy so we can sign off on it and sign off on its compliance. And if not, we can at least identify what's wrong with it and go back to the board or go back to the lender and say, hey, look, you must make these changes because residential mortgage financing is not going to be available on your property. What I did, and look, I'm close to 30 minutes. I love doing these 30-minute webinars. What I did is I included some of the links to Fannie Mae's new condominium lending guidelines and Freddie Mac's new condominium and cooperative lending guidelines. But what I also included is this FAQ here today. So the Fannie Mae FAQ, and I'm going to end with this today, and I don't think we're going to have enough time to go through questions, but if you do have a question, please feel free to ask it, and we'll try and get that back to you. I do want to show you what Fannie Mae's FAQ looks like. So I'm going to share that screen so everybody can see it. So Fannie Mae's FAQ, which is a link that I provided on the page, provides amazing data and amazing guidance that you could look to determine whether or not a condominium or cooperative development is compliant. And I'm focused here on this, number 21, and it's one of the points I made earlier. And these are, this FAQ is, lenders asking questions to Fannie Mae, and when Fannie Mae puts it in writing, you can take that to the bank. It's a bad joke, but you can. And what we like to see are, these answers in writing so that, the agency informs the industry. So question 21, policy states any unfunded repairs costing more than $10,000 per unit that should be undertaken within the next 12 months does not include repairs made by unit owner or repairs funded through a special assessment. Can Fannie provide further definition of unfunded? Would special assessments that are not yet paid in full be considered funded or unfunded? Are association loans acceptable or an acceptable source of funding for repairs? And Fannie's answer is, by unfunded, we mean the HOA does not have the funds in place to pay for the repairs and must postpone the remediation, right? Really clear answer there. It is acceptable if the HOA imposes a special assessment or obtains a loan to fund the repairs. However, if the special assessment is related to safety, soundness, structural integrity, or habitability, all related repairs must be fully completed. So that tracks exactly with what I outlined earlier and outlined regarding special assessments and the repairs that are necessary. And I thought it was really important to include that FAQ in this presentation for you today. So that being said, Melinda, do we have a question that we can answer right at the one minute, at the 30-minute mark, at 31-minute mark? Is there anything that's come up?
Absolutely. Let's see, there's a few of them. Let me see where to start real quick. Just give me 1 second. Does Condotek look for these violations and litigation, or do we as the lender have to provide that information to you?
So both. Sometimes we ask for the litigation information and or violation information from the lender if they have a title report in place. And sometimes we go out and collect that information. Most instances, we go out and collect that information either from the questionnaire or from our searches that we perform on the site. It's important to note, we launched a title ordering platform at Condotek last year, where we chose 3 nationwide title companies, and we did that when you place a Condotek, condo pack or condo project warrant order, you could also, along with it, order a title report. And we did that because we kind of had a crystal ball here. We knew that if we had access to those title reports sooner, we could do a more comprehensive review. And it's been successful where we're getting title reports, violation searches, and really some good data on properties prior to where we when we would have gotten it, just by having lenders utilize that title ordering platform. These title companies are very interested in making sure this is successful and understand the condo world, and understand how quickly these reports need to get completed. And the title companies we chose have committed to providing those title reports in 10 days. So very excited about that. And if you have questions about that, please contact us and we'll show you how to place an order there as well. And that being said, I want to be very respectful of everybody's time. So any other questions that have come up on this webinar, we're happy to answer. Melinda and I will dive into it with our team, and we will provide answers either directly or via an email that comes to you with a recording of this presentation. But the last thing I want to leave you with today is we are here to try and answer as many project compliance related questions as possible. The industry has changed, and my joke is my father's joke, which is what was and what is. He used to tell me that when I was a teenager. I think I mentioned it in every webinar. And what we're seeing is that the jumbo and non-warrantable world has also changed and has adopted a lot of these aging infrastructure lending guidelines. So contact us. We're happy to provide the knowledge and the expertise that we have in answering your questions about eligibility. I would say that your first step, though, is going to Freddie Mac's or Fannie Mae's FAQ to see if that question has been answered before, because it's such a fantastic resource for the industry. So that being said, thank you so much for joining us today. Again, we're going to run these 30-minute webinars pretty frequently, and we think that's just enough time to kind of give you some data and let you go back to working for the rest of your day. Thanks again. Enjoyed presenting to you.